Step onto any retail trading floor, open your favorite financial forum, or scroll through modern investment platforms, and the ticker NOK is frequently trapped in a time warp. For years, the general consensus treated Nokia as a corporate relic, a nostalgic ghost of indestructible 1990s mobile handsets, and a sluggish, legacy-bound telecom vendor caught in the twilight of traditional 5G rollouts. Trading comfortably below the radar for the better part of a decade, it was branded as the classic dead money clay. Yet as we look at the live market boards in August 2026, with the stock stabilizing near 1409 following a breathtaking multi-month vertical surge that tested 17-year highs near $17.45, the structural reality of the business couldn't be further from the retail narrative. Wall Street heavyweights like J.P. Morgan and Bank of America have aggressively revised their thesis, hanging ambitious price targets upward of $21 as they wake up to a fundamental mispricing. The market missed the forest for the trees because it failed to grasp the physics bottleneck of the artificial intelligence supercycle. While retail investors obsess over headline-grabbing GPU manufacturers and consumer-facing software wrappers, they ignore the physical reality of what happens when millions of enterprise-grade accelerators are clustered inside massive hyperscale data centers. AI training and inference do not live in a vacuum. They require astronomical volumes of data to be shifted across server racks, metro rings, and global wide-area networks (WANs) at near-zero latency. When you scale cluster sizes to tens of thousands of GPUs, copper interconnects hit a wall due to thermal limits, signal attenuation, and power constraints. The entire physical world of AI processing relies on an invisible, highly complex plumbing system of 800 G-class coherent optical engines, advanced IP routing, and carrier-grade fiber infrastructure. Nokia is not just a phone maker of yesteryear. It is quietly transformed into an indispensable digital gatekeeper powering the data center interconnect backbone that makes modern AI execution possible. Institutional desks recognized this pivot long before the retail crowd, quietly accumulating shares during macro pullbacks while casual observers remained blinded by outdated stereotypes. The trading behavior of NOK throughout 2026 offers a textbook masterclass in institutional accumulation followed by explosive re-rating. Following a stellar Q1 earnings performance and upwardly revised full-year guidance, the stock experienced a violent volume-backed repricing that caught short sellers completely off guard. Daily trading volumes exploded past historical averages, driven by institutional block trades and structural reallocations from generic tech indexes into specialized hardware infrastructure plays. However, because this vertical surge invited sharp technical profit-taking and broader macroeconomic jitters around central bank interest rate paths, the stock retraced from its yearly highs back toward the mid-teens. This is precisely where smart money operates. While algorithmic panic selling shakes out retail traders who bought the absolute peak on social media hype, institutional heavyweights use these dips to build massive long-term inventory. The underlying order book tells an encouraging story. Long-only institutional funds are steadily increasing their allocations, supported by a healthy, sustainable dividend yield of roughly 1.59%, backed by a conservative payout ratio and an aggressive multi-year dividend growth rate. Major investment banks are leaning heavily into the thesis that Nokia's expanding order book for cloud and AI infrastructure will materially rewrite earnings expectations heading into 2027 and 2028. Are you currently holding Nokia shares in your portfolio, or are you waiting for a deeper technical pullback to establish a long-term position? Let us know your strategy in the comments below. To understand why Nokia commands such a vital position today, we have to strip away the decades-old consumer baggage and look closely at its operational metamorphosis. Effective January 1, 2026, Nokia streamlined its sprawling structure into two core high-focus operating segments designed to laser-target the AI and cloud supercycle. 1. Network infrastructure. This segment consolidates optical networks, IP networks, and fixed networks under a single high-performance unit. It is the absolute crown jewel of the modern investment thesis. Driven by the explosive demand for data center interconnect, DCI, and metro core scaling, Nokia's leadership in 800G coherent pluggables and ultra-efficient optical systems allows hyperscalers to link distributed AI compute clusters with minimal latency and maximum power efficiency. By leveraging vertically integrated optical engines, Nokia secures a dominant market share position outside China, commanding pricing power in high-end routing and switching. 2. Mobile infrastructure. Bringing together core networks, radio networks, and technology standards, this division represents a profound shift away from hardware-heavy commodity sales towards a software-first, cloud-native operational model. Rather than depend entirely on traditional slow-growth mobile carrier spending cycles, this unit focuses on RAN automation, cloud-native 5G core architectures, and early pioneering work in AI-native networks and 6G frameworks. By embedding machine learning directly into network controllers, near real-time RIC applications, Nokia helps telecommunication service providers slash operating costs while optimizing radio resource allocation. This structural realignment has systematically purged low-margin drag, allowing the company to target a formidable comparable operating profit range of 2.7 billion to 3.2 billion euros by 2028. The old narrative of a fading handset maker has been entirely replaced by a high-margin, software-driven hardware engineering powerhouse. Looking toward the multi-year horizon, Nokia sits at the intersection of several massive technological tailwinds. Global AI infrastructure spending is projected to scale aggressively, with fiber deployments and wide-area network bandwidth requirements growing at double-digit compound annual growth rates. As hyperscalers race to build out dense GPU clusters, the physical bottleneck shifts from compute power to data transit. Nokia's cutting-edge optical portfolio, featuring quantum-safe data path encryption, thin transponder layers, and AI-powered network automation, positions Nokia as an unavoidable gatekeeper for next-generation cloud architecture. Furthermore, early standardization work in 5G advanced and 6G infrastructure ensures that Nokia will dictate how industrial IoT, automated smart cities, and real-time digital twin environments communicate over the next decade. However, prudent investors must remain clear-eyed about the associated risks. The company's trajectory is deeply tied to the capital expenditure cycles of mega-cap tech spenders and Tier 1 communication service providers. Any sudden cooling in hyperscaler data center budgets or macroeconomic contraction could temporarily compress order velocity. Additionally, geopolitical friction, supply chain vulnerabilities for advanced semiconductor components, and fierce competitive pressures in global telecom equipment markets require flawless execution from management. Yet when you weigh these execution risks against the structural tailwinds of the AI networking revolution, short-term price volatility fades into mere noise. Nokia has successfully reinvented its operational DNA, turning historical skepticism into a massive asymmetry for investors who are willing to look past the superficial headlines and invest in the literal backbone of the digital age.